it very educational, you know, and at the end of the day, if anything, it'll provide you and your clients with another option, at least to consider. So with that, John, if you've got that PowerPoint.
I do. Give me 1 second here. I'll pull that up.
And John, do you mind if they have any questions in the interim? They can just chime in.
Yeah,
Or
that's
you want
fine.
the
Yeah.
questions in the chat? Okay, okay. So again, I'm here in Los Angeles. I'm with Arcadia Settlements Group. We're a national company. And so this structured installment sale, it's available via, again, through MetLife, but it's only available to our unique broker channel. This product is available in 49 states and Puerto Rico. And I typically get asked, what's the 50th state? And as most people will recognize, it's New York, where it's not currently approved. But there are other products that are coming down the pipe that will allow us to offer the same product in New York. Next slide, please. So quick disclaimer, this material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. Please consult your own tax, legal, or accounting expert. We do not offer tax advice. Having said that, if anywhere in this process, buyer, seller, anyone has absolutely any questions, bring them to me and we'll get those questions answered. So a little bit about the installment sale or the structured installment sale. This product is for properties that qualify and are eligible under Internal Revenue Code Section 453, the installment sales section. And so what's an installment sale? A typical installment sale is where the seller receives at least one payment for the sale of that property after the tax year in which the sale occurs. And it could be one payment, it could be, you know, more than one payment over so many years. And the structured installment sale, what we're going to do is we're going to convert that lump sum payment that typically would go into escrow and convert that into a guaranteed income stream, and we're going to spread those payments out over time. Qualifying properties include a primary residence, rental property, commercial property, land, to be vacant land, and the sale of a business. Again, anything that qualifies under Internal Revenue Code Section 453. So what we're going to do is we're going to take that lump sum payment and convert it into an annuity payment. So let's start with the basics. What's an annuity? An annuity is funded with a single lump sum payment initially, and then it'll generate future fixed payments over time. And I've got some examples to show you shortly. The first payment is typically due within 1 year of the sales transaction. So you can sell a property today in August and take some cash up front and say, hey, make that first payment sometime next year. So you can immediately start spreading out some of that tax obligation. The duration of the annuity payments can be up to 40 years of guaranteed payments. The payments can be monthly, quarterly, semi-annual, or annual payments. Again, one of the other great things about this product is these payments are fixed. So once they're set up, they are not subject to change. And because of that, there are no management fees. So whatever that monthly or that annuity payment's going to be, once it's set up, there's no management fees. Now, each annuity payment will consist of the return of basis, capital gains, and interest. So there's an interest component to this as well. So whatever that dollar amount is used to fund the annuity, it's going to generate a larger payout over time because there's an interest component to that. So John, if you can scroll down just a little more there. So just kind of an FYI, right? Here's an overview of the tax tables. So something to keep in mind is, you know, as far as capital gains is concerned, it's not just the proceeds from the sale of the home. The seller has to consider any overall annual taxable income when they're looking at these tax tables. And again, I am not a tax person, so we want these sellers to talk to their tax folks, their legal folks. But these are typically the types of taxes that they're subject to: federal capital gains tax, the federal net investment tax that a lot of people seem to kind of forget is applicable as well, and then the state capital gains tax. And I've got a note at the very bottom, because on occasion when somebody's looking to sell their rental property and they've depreciated it over time, there might be a depreciation recapture tax on that as well. So that these are the taxes to kind of keep in mind. But I want to bring your attention to, let's just say if we go to federal capital gains tax married joint, you'll see the applicable tax rates. Now, if you go down married file joint, that 20%, and you'll see that anything over 583,750, it's subject to that 20% tax. Now, if we're able to take some of those sales proceeds, spread them out and lower them over time, we might be able to immediately move someone from a 20% tax bracket into 15% tax bracket, right? And if you look at the federal net investment tax married filing joint, it's applicable for any capital gains or proceeds, taxable income over 250,000. Again, if we can lower that annual taxable income to something under 250, then we can avoid that tax. So that's kind of what we're looking at. And we're setting these up with the input of the seller and or their tax and or legal person to tailor these to the benefits of the seller, depending on what it is they're trying to accomplish. Next slide, please. So now let's talk a little bit about the annuity and what does that actually look like. So property sells for $1.5 million. And let's just assume there's no mortgage or liens on the property. So it sells for $1.5 million. The seller decides, they determine how much cash up front they want to do a host of things. It could be they want a slush fund, they want to pay bills, whatever it is, right? So now they want to defer $1 million of those proceeds now, right? So $1.5 million goes into escrow. Escrow pays out $500,000 in cash. And then we're going to instruct escrow to pay the other $1 million to the annuity company so we avoid that constructive receipt. And these are just examples that I ran about a month ago, the rate of returns and what kind of benefits you might see if you were to annuitize $1 million. The rate of return on these benefits, it's going to be about 4%, give or take. So if we just take that first line and somebody says, well, here's $1 million, but I want you to pay it out MetLife over the next 5 years. What does that look like? Well, $1 million can generate $18,390 monthly for 5 years guaranteed. Remember, the payments are fixed and there's no management fees. So you'll see that using $1 million is going to pay out $1.1 million over that 5-year period. But more importantly, I think, is look at what we did to lower that annual income tax. We went from $1 million to lowering that annual taxable income to $220,000. So we've immediately put them in a separate tax bracket. And that's what this annuity does. So if you just go down the line, you'll see that if we, line number 2, what if we did it for 7 years? Well, it's going to lower the monthly because we're going to pay it over a longer period of time. But now the total payments keep going up, right? They increase. The longer the term, the higher the payout because it's paying more interest during that time period. And again, I think more importantly, if you look at what we're doing to the annual income, we're starting to lower that annual income to try to achieve getting them into a lower tax bracket so they pay lower taxes over time. Next slide, please. Right, and this is kind of the same scenario. Somebody bought the property for $300,000. The adjusted basis is $500,000. They sell it for $1.5 million. Disbursement from escrow, $500,000 in cash, and defer $1 million. And I wanted to set this up so you can see kind of a snapshot of what something like that might look like. If you look at the disbursements, right, they sold for $1 million, $500,000 is cash, $1 million goes into the annuity. That total disbursement is $1.5 million. But let's slide over to the right, right? So that what's the total payout going to look like over that 10-year period? Well, you've got the $500,000 in cash. The annuity will have generated $1.2 million over 10 years. So now the seller's going to receive a guaranteed return of $1.7 million, just by initially selling that house for 1.5 million. Now, I'll pause here to show you something else that's kind of neat about this. Let's say, for example, you've got a seller and they want to sell for 1.5 and the highest bid you've got is 1.4. And, they're kind of, hesitating, but they want to take it. They're not sure. Look, with 1.4, we can still generate a larger payment over time. And we might be able to exceed that 1.5 over 5, 7, or a 10-year period. But in addition to that, we're probably going to wind up saving them quite a bit of money on the taxes as well. So you can start getting a little creative with this. As a matter of fact, I've had a couple buyers approach me and say, can I use this? I say, well, of course. If they want 1.5 and you offer them 1.4 with this product, it's something they might seriously consider because you've got them out of some sort of a dilemma and they just want to hurry up and sell, right? So we can start getting a little creative as to how this product might be used. Down at the very bottom, and I state for illustration purposes only because I've had this question quite a bit, is what would be the applicable taxable gain? You all, I'm not in real estate, so you all may know this better than I do, but this is kind of a quick formula as to how you determine that capital gains factor. Okay, next slide, please. So let's talk about some of the options with this structured installment sale. Number one, it's good for primary residence, right? Can't say that enough. It allows the seller, it's now giving the seller some options, right? Converting a lump sum into guaranteed income. And maybe they want to move into a smaller home, into a house that's just a single story. Maybe they want to sell their house, move out of state, be closer to the grandkids on the other side of the country. Maybe they've got multiple assets. They want to start diversifying. They can sell one of their assets. That might include selling one or more 1031s that they no longer want to manage. With these annuities, the payee and beneficiary may be a trust, right? It could be a living trust. It could be a special needs trust. And the reason I put a special needs trust in there is in my years of settling all these variety of claims, I've had payees that are on Medicaid or Medi-Cal. And you've got to be careful if you get too much money coming in because you may become ineligible for Medi-Cal. And some of these folks need it for health reasons. So there might be an opportunity for them to sell their properties and put cash and annuity payments into a special needs trust so we conserve those Medi-Cal benefits. Again, every case might be different. So if you've got any scenarios and you want to run them by us, just let us know. We'll see what we might be able to help you with. The next example is actually a seller that brought it up at one of the events I attended, where the parents aren't confident adult children can manage their property or their business. And they may have multiple properties and they're considering selling one or more of those properties now versus giving it to their adult children, setting up guaranteed income for themselves as the seller. But if they pass away prematurely, any remaining payments will go to their children as beneficiaries. Another option may be to reinvest some of the excess payments. So these are fixed annuities. They're pretty conservative annuities. Some folks will say, well, I can get a better rate of return out on the market. Well, yeah, but you would have to get access to that cash, which means you're going to pay capital gains. You're going to try to get a higher rate of return on the market, but how much do you have to make in the market to offset the capital gains you just paid, right? So those are things to consider. The other thing to keep in mind is if you make those annuity payments for a shorter period of time, the payments are larger. Well, some people don't need $15,000 a month to survive. Maybe they only need $5,000 or $7,000. That seller can take that excess every month, have their financial planner reinvest it. Maybe it could be reinvested in more aggressive type of financial products, knowing that even if they were to lose money with those aggressive financial products, our annuity payments are still fixed, guaranteed, and they're still coming in as promised. Another way of looking at this is it can generate supplemental retirement income, especially with some of these folks that have their own business or other folks. They just don't have retirement plans, or it's very minuscule, right? Whatever they may be getting, that life pension Well, this fixed annuity could provide some of that supplemental retirement benefit. And having this income can help them defer on other retirement benefits, including putting off drawing on Social Security. If they've got this guaranteed income, maybe they can hold off on Social Security, and maybe that continues to grow over time. And I think the next two bullet points are, especially in my experience in settling claims, these are the real important ones, right? Which is, you'll have fixed income to pay recurring bills. We all have recurring monthly bills, gas, groceries, utilities. It could be various premiums. It could be, auto premiums. It could be health insurance premiums. And maybe, it'll give the seller an opportunity to improve their quality of life by getting a better health plan, something of that nature, right? So not only are you going to sell your home, but how can we also improve your quality of life using some of this money? And if you've got these premiums due, well, you'll have some steady income to address those premiums that are due. The other thing is to generate income to pay for home care, assisted living, and retirement home. Quite a few people that I've spoken to, 70s and 80s, I'm in a house that's too large. My kids don't live with me any longer. I'm not sure, where to go. I'm looking at home care or assisted living, but I've only got my primary home. I'd like to downsize and maybe get into that retirement community that I've been eyeing. Well, here's an opportunity to do something like that, right? You can sell your primary, generate guaranteed income, and use that money to offset some of those expenses in any types of these homes. And the last thing I wanted to mention here was, again, bridge the gap between the offer and the seller's asking price. So again, kind of like that previous example I gave, you can still use lesser monies to generate larger payments over time, and that might be able to allow you to bridge that gap. The last thing I'll say about that is, I've had quite a few people that I've spoken to have said, I'm afraid. I want to sell. I want to downsize. I just don't have a plan, so I'm stuck. They're looking at you all maybe to say, well, here's another option. Because I see quite a few of them, they're just frozen. They're not sure what to do. And I think this may be an option for some of these folks. So when you compare this tax deferral product, let's compare this product to other tax deferral products. Again, some of the benefits: eligible for primary residence. The payments are issued by a highly rated, regulated life insurance company that's been around for 150 years. The seller designs the payment terms and the plan tailored to their immediate and future needs, right? So it's a matter of talking to the seller and say, what is it you're trying to accomplish? I know you want to sell for the maximum, and maybe you're hesitant. Why are you hesitant? What are you trying to do after the fact? Well, I want to do these things. Well, all right. Let's see if we can tailor make these payments so you can accomplish what you're trying to accomplish. Because these payments are fixed, they are not subject to change. They are not affected by any market fluctuations whatsoever. It's got a competitive rate of return right now. Again, it's about 4%. If you pay it out even longer, 15, 20 years, then you'll be closer to like 4.5%, something of that nature. Most people that are interested in this product, number one, tax deferral. Number two, hey, if you want to pay interest on top of it, that's the icing on the cake. That's fantastic. There are no ongoing management fees. So if the annuity is for $5,000 a month, that's it. The seller gets $5,000 a month. It's never subject to change. There's no management fees or anything of that nature. There is an option to add a COLA, a cost of living adjustment, to the annuity. The maximum currently is 3%, is the maximum COLA that the underwriting requirements allow for. So what happens is, say, for example, you do a 10-year guaranteed period. So that upon the death of the seller or sellers, any remaining payments are payable to the beneficiary, whoever the sellers elect, in the same amount. Once this product is set up, the sellers at the time we set it up will have a one-time option to decide, if I pass away prematurely, let all the payments just stay payable as monthly or quarterly. Or, hey, if I die prematurely, liquidate 100% of that, the remaining payments to present value, and issue a one lump sum check and just end it. But they also have the option to say, liquidate 50% at present value and keep the other 50% as a monthly benefit payment and keep that going, right? So it allows us some flexibility. Some folks like the liquidation option because it helps address any possible future estate tax type issues. Again, but we can tailor make these any way the seller would like. There are some underwriting requirements, but we can address those on a case-by-case basis. If there's going to be any limitations, is that these are fixed annuities, but once they're set up, you cannot change them. There's no liquidity. And I have an asterisk there only because the exception to the no liquidity is if the sellers at the beginning wanted the option to liquidate any remaining payments. But if the seller says, hey, I need $50,000, can I take a loan against it? You cannot. Is there any cash value? There is not. So there's no liquidation. There's no changes to these annuities once they're set up. So we also want to make sure that the sellers have liquid assets somewhere. And I'll give you an example. If we decide to go with MetLife, they're going to ask the buyer and the seller to complete certain documentation. The underwriters want to make sure these sellers have liquid assets, because once this annuity is set up, if they're in need of liquid assets in the future, it's not going to come from this annuity. Right? They just want to make sure they're doing the right thing and doing the right thing by these folks as well. Next slide, please. These are just some of the scenarios I've seen as of recent. I had a single female out here in Los Angeles, age 75. She was single, selling her rental property, wants fixed income. She wants an additional retirement, kind of a pension plan. And she just kept telling me, Angel, just don't lose any money. Not even a penny. I work too hard. Just don't. And it's interesting because I've got other financial folks saying, yeah, but if she gives me money, I can play the market. And I say, yeah, can you lose money? Well, I can lose, but if it's a good market, she can make money. And I said, some of these folks, and I'm pretty conservative myself, she's asking you, don't lose a penny. And I said, you won't. You cannot lose money with these fixed annuities. I had another couple in their mid-70s sell their rental condominium in Florida, which does not have state capital gains. And in conversations with their tax person, we were able to lower and spread out those payments over time, and actually got them into a zero capital gains tax bracket. So they're not paying any capital gains. They're not paying any investment income on that as well. At that time, that sale was only about $350,000 that they had to put into the annuity. So it wasn't a lot of money, but it was just enough. And again, they tailored it that way so they can maximize not having to pay so much taxes. Another couple up north, the wife is 70, the husband is 82. And I was always of the opinion, even if you had a large house, it might still be cheaper to stay in that than move somewhere else, especially because new homes are so expensive. And what the husband told me, he's like, Angel, you don't understand. He's like, it's 5 bedrooms. The maintenance on this thing is killing me. The gardening expense itself is I can't keep up with it. I'm on a fixed income. It's literally too expensive to live here. And I need to find a smaller place to live in. So I had another single female, 65. She wants to sell her California rental property. Her main concern was the laws are getting too restrictive. There's a lot I can't do any longer. And I took early retirement and I have a low pension. And so this gets me out of my rental and gives me a nice rental income or supplemental retirement type income that I can live off of. The next one, female, 95 years old with a living trust. She wanted to sell her rental property now, use the fixed income to maintain her current care. And remember, the house is in the living trust. But so she wanted, which will set up the annuity. You issue the payments to the trust. The trust will help take care of me. When I pass away, liquidate 100% of any of these payments, if there's still any payments that are left, commute them at present value, issue that payment back into the trust. The trust will distribute the funds to the remaining children, how it was dictated, however the trust, it could be, evenly or however she wants it dispersed. The other one with the kind of interesting, you start seeing everything, right? When you start talking to folks, the mother wants to sell her home, her own primary home, to her daughter, who she claims to be very responsible, and then live in the same house, but not include her adult son, who can't manage anything, including money. So she figured, I'll sell it to my daughter, generate this annuity income, and then name my son as the beneficiary of the annuity. So if and when I pass away prematurely, he'll get the annuity proceeds. And even though he's not responsible, even if he blows that first annuity payment, he can't liquidate the rest of it anyway. So now I've put him on a payment plan so he can't blow through this money prematurely. So you start seeing, like, okay, again, we go back to the sellers and try to figure out what is it you're trying to accomplish, and let's see what we can offer you to try to put together. And the last one was single male, 55, looking to sell his commercial properties. He's been buying commercial properties since his late 30s and has 5. And so he found this product pretty interesting. Next slide, please. So the timing of the transaction, I would suggest you get us involved as early as possible. How early is that? If you've got a seller that's thinking of selling next year, that's fine. You can reach out to us. Let me run some quotes. Let's let us all have the seller get their head around this thing. Maybe talk to their tax people. Especially when they're in their 70s and 80s. In my experience, I've noticed they want information kind of in drips. Like, don't give me too much. Like, let me look at these numbers for a while and I'll get back to you. And then they do. They call me back 1 or 2 months later. Okay, let's go to the next. What do you need? And I talk to my tax person. So get us involved as early as possible. The quotes are free, absolutely no commitment. My goal is to have these folks make an informed decision. Even if at the end of the day I've run 20 quotes and they say thank you, not interested, I've done my job, right? We've given them the information to make a decision. The seller should advise any buyer as soon as possible. So if they decide to use this product, they want to let the buyer know, hey, if you do decide to buy, we're going to enter into this transaction, and there's some documentation I need you to complete as well. If, again, buyer, seller, anyone has any questions, have them ask, they can contact me anytime. The documents to be executed by the buyer and seller, there's going to be various, including the assignment of the future periodic payments. So technically what happens to make this product work, it's still under the installment sale, IRC 453. We're going to create those annuity payments, and technically it's the buyer that says, hey, I promise to make these these monthly payments to you, but I'm going to assign my obligation to MetLife, and MetLife signs the same documentation that MetLife says we assume this liability, and we, MetLife, will make these payments going forward. Escrow will fund the annuity. So again, they've agreed on a sales price. The monies go into escrow. We're going to instruct escrow where exactly and how to make that annuity payment payable to MetLife. We're going to give them their tax number. So we want to make sure there's no constructive receipt. And after the transaction, the buyer and the seller, they go their separate ways. I say here, there's no lien on the property. I've had a few questions, hey, will MetLife look at the property? No, they don't have anything to do with the sales transaction. They don't, as long as it's a property that qualifies under 453, they don't need to look at pictures. They're not concerned about any of that. There's no lien on the property either. It's still just a straightforward sales transaction. Someone else asked, what is the buyer's lender going to say about all this? They really shouldn't say anything. It's still a straightforward transaction. It doesn't affect what a typical sale would look like. You know, MetLife's not getting itself in the middle of it. It's almost as if the sales process is going forward and MetLife is assisting the seller immediately after the fact by making these periodic payments over time. And then once everything is said and done, all the documentation has been provided, an annuity contract will be issued to the seller or sellers. And so they'll have a copy of an annuity contract from MetLife saying, we promise to pay you exactly what those payments are. Next slide, please. I think this is my last slide. So what do I need to run a quote? Again, the quotes are always free. There's never an obligation. The full name of the sellers, I need dates of birth. Let me pause here for a second. The MetLife annuity product, those payments have to start before the age of 85. Now, I previously showed you an example where somebody at the age of 95 wanted these annuity payments. So I've also got access to U.S. Treasury bonds that will issue these type of payments. The rate of return is going to be lower. And I've got one other annuity company that is starting to write these annuities as well within our unique structured settlement channel. They will write that annuity for that 95-year-old. So my 2 cents would be, if you have a scenario, you just call, let's just discuss it and see what are the options, and we'll go from there. So in addition to the name, date of birth, what's the type of property that's being sold? Where's the property located? What's the estimated dollar amount that they want to annuitize or defer? What are the duration of payments? 5 years, 7 years, 10 years? You know, they may not know the duration until they actually see 1 or 2 quotes, and then they'll get a better sense of, oh, okay, you ran it for 10 years. You know what? I want a higher monthly. Can you do it for 5 years or 7 years? And let me look at that. And the estimated property sale date. You know, you might have somebody that says, yeah, I have to get rid of this property before the end of the year. Just give us an idea so I can kind of put it on my calendar. I can coordinate with you all to make sure everything needs to get done. And again, somebody you may be talking to just says, yeah, it sounds interesting. Let's talk about it, because we all know how sales work, right? They may ask you for a quote today, and maybe they'll call you 3 years out saying, you know what? I think I'm ready to pull the trigger on this thing. You know, you talked to me about it. Let's go back and look at that option. And I understand that as well. Next slide, please. Well, folks, that is it for me. I thank you all. Again, my office is in Los Angeles. My full contact information is here. And John, if you have any questions or anyone else has any questions, I'd be more than happy to take them.
Yeah, there was one of the questions was, does the money MetLife is holding in the annuity account earn interest and grow in any way during the payout period? And I know the answer to that, but go ahead.
You know, so, and you can, and quite frankly, folks, you can also look online, look at MetLife's structured installment sale, boom. It's just a ton of information on there. They're a pretty conservative company, and they'll show you how they invest their money. But quite frankly, however they invest their money, even if they lose money in any one of those buckets, they have a contractual obligation to make whatever that monthly payment or quarterly payment is. And how do they make their money? Because it's an annuity. And the annuities are typically used for retirement. But so this product, you know, we're going to use it in a slightly different scenario. These annuity companies take in a lump sum. And when you think about it, let's assume we give them $1 million. Oh, okay, well, we'll pay $10,000 a month. That's what you want. So what are they doing with the balance? They're reinvesting it. So in my previous examples, where you saw quotes at a cost of $1 million and a payout of 1.1 million, yes, they're paying more out the door, but they've still made enough money where they're still making a profit, which is why they're in this type of business.
And their reserves, obviously, as an annuity, have to be higher than some of these other areas that they're providing.
Absolutely. You know, and there's all these other tax deferral products out there. I've got nothing ill to say about any one of them. This is just a different option. But if you put up a MetLife insurance company with the reserve requirements that it'll stand out above the rest. I mean, it's a reputable company. The ratings are there. You know, they have to adhere to the Department of Insurance for every state in which they're approved in. The reserve requirements are pretty stringent. And well, that's why it's been around for 150 some odd years and continues to make the payments, right? So even in my lifetime with the crash of 2008 and even more recently, the ups and downs, they continue to make annuity payments on time, and no one's lost a penny.
Okay, so we have one other question. Does this cover a second home, which is not a
Absolutely.
rental?
Absolutely.
I
Barb?
have some questions.
I do. Unfortunately, Angel, I cannot thank you enough. You've put enough in my head right now to be wildly dangerous should I open my mouth. But with that said, I'm trying to wrap my head around this. And from a buying and selling standpoint between the buyer and seller, it's actually not a whole lot different than how a 1031 works. I'm thinking as far as no liens, blah, 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 blah. But it is very much the same process, only with the primary residence. Now, with that, am I okay so far? But with that said,
You are, but they're two total rights. It's not close to a 1031 at all. Two totally different products.
right,
But hey, buyer seller, there's some documentation you need to fill
Yeah.
out. That's true.
Yeah, there's got to be an
Okay.
agreement, just like a 1031. The buyer has to agree that the seller is going to do
Yeah.
a 1031 exchange.
and probably the terminology is at no risk to the buyer and yada, yada, blah, blah. Now, this seems to be the perfect product for a 75-year-old. I'm making this up, but not really. I have somebody in mind. 75-year-old woman with investment property and a big primary residence who doesn't want any more hassles in their life and has irresponsible 50-year-old kids.
Yeah.
Is that correct?
Absolutely.
Okay.
That's almost
I mean,
the
I'm not
sweet
trying to-
spot based on my limited years
Okay.
of doing this product. That's really, really it. It protects,
Okay.
it starts protecting people as well.
Okay. Wow. I mean, I'm just a little bit blown away, but fascinated right now. So thank you. Anyway.
And,
Very,
you know,
very
the
well.
nice-
I
And
have
I
some
know-
questions.
Nancy, go ahead.
Okay, hi, Angel, this is Nancy. Is there a cost to the buyer of the house?
None. None.
Okay,
No,
because you said you let them know early on that you're going to do this, but you just inform them like a 1031. It really is just paperwork adjustment. It's not going to financially hit them.
yeah, the sales price is never going to be affected. Hey, you buyer, seller, you guys agreed to $1 million. We're just going to take $500,000 of that dollars that's already in escrow, and we're going to go shoot it over to MetLife. But in order for this product to work, the buyer has to be in agreement. And I want to go back, Barb kind of mentioned something. If you're going to get pushback, at least initially, it might be from the buyer. Why would that be? Because for it to work under Internal Revenue Code Section 453, and as conservative as MetLife is that, hey, buyer, here are the annuity payments. You promise to make them to the seller, but part of the transaction is you're going to sign it to MetLife, and MetLife will assume the liability. So on occasion, we get the person that says, so 5 years, $10,000 a month. What happens if MetLife goes under? Right?
Mhm.
It's a great question. So technically, buyer, you're back on the hook, but then let's go back the other way. So what we're trying to do is educate these folks. In the transactions I've done, the buyers never ask that question. They just sign off because we're educating them. The company that's been around for 150 years has to go bankrupt in the next 5 years so it doesn't make this right, complete that obligation. And remember, annuity companies, they can't file bankruptcy. They go into receivership. So all the other annuity companies kind of come in to see if they can help prop this up. So if you're going to get any pushback, it's going to be there, but we're going to educate the buyer as well. It's not come up in my scenario. And then in talking to some folks, if you sell for $1 million and you've got a hesitant buyer, well, I'll let you have it for $980,000 if you sign on the dotted line. You know, the seller will still make it up on the back end anyway. But it's not for everyone, right? So this product, it's not magic. It's fantastic. But if somebody's got a concern, I wouldn't be surprised if 1 out of 20 say, I'm uncomfortable. Well, you know.
But the buyer gets full title, right?
Absolutely. Met has nothing to do with title. There's no lien. They just go their own separate way. Like that example I showed in Florida, he was adamant. And I talked to the seller quite a bit. And he said, oh no, I just told them, hey, you want this property, you're signing that dotted line. If you're not signing, there's other people right behind you. So get out of the way and let me go.
Okay. I have another question. This is specific to where I live. Friend of mine just turned 90 and his wife is 75. They have a home they don't really want to stay in any longer. You just said that you wouldn't do anybody over 85. So
Yeah,
if they put the title in her name only, could they do it?
That's an excellent question, Nancy. I actually had that scenario come up. And if I remember correctly, if they're joint, if they're both on the property as common, we should be able to do it because they're going to look at her age.
Yeah. Yeah, because she's the beneficiary, or well, hopefully.
Yeah, so we use her age of 75 to qualify that for her. And the way this product is set up, so I've got underwriting requirements I have to meet before it gets to MetLife. Then it goes through their underwriters to make sure it's okay, but that's fine. If we get any pushback or anything like that, and I typically go out to them because once a week I get a different scenario that's like, well, this is fascinating. I've never even thought about this. And I run it through the underwriters and they'll say, yes, they'll take it, or no, they won't. So my 2 cents would be, if you're curious, let's just run through the exercise. You'll learn something, I'll learn something, the annuity company will learn something. And this product, I think, will just continue to grow over time.
Yeah. You know, the nice thing about this is that you could do it as many times as you want, correct?
Yeah, as long as you've got multiple properties,
you got 10 investment properties. What a great way to mitigate those higher capital gains taxes.
Yeah. Yeah.
Fascinating. Thank you very much for your info.
Oh, absolutely. And I'm sure you're going to have questions once we hang up. That's how all these products work. Don't hesitate to reach out to me. I can do these for your offices, or, just shoot me an email. Angel, I've got a scenario. You can call me. We can talk about it, or you can shoot me an email. I'll run some numbers just so you get a better feel as to how this product works.
One more question. You're not an employee of MetLife, right?
I am not. Okay. So I represent various annuity companies. So I give my clients options to everything. Currently, it's just MetLife that has this particular product. Actually, I have another annuity company, Puritan Life, that's starting to write this. They've been around 50 years, but they like where this is all headed. And back in the early 90s, Allstate and Prudential created this product as well. But because of the housing market back in that day, there really wasn't a need for it. Allstate stepped out of our industry and Prudential shelved it. And so MetLife says property values are up, this might be a good time. So MetLife introduced this just before the pandemic. So because it's only available to our unique broker channel, and they individually approve brokers to sell this particular product, that's why you don't see commercials for it or anything of that nature. But to my point, you can Google MetLife structured installment sale. You'll see all their information up there. If anyone needs a white paper, I've got their white paper. So, MetLife is a type of company, they're going to do all their due diligence before they introduce anything. And they've done it with this product.
Wonderful. Any other questions? Well, Angel, I think you kind of blew us up here with some great information. Well, it's just another tool for the real estate agents and talking to folks that we know people bought houses for $300,000 are now worth $1.5 million, $1.8 million. They get to keep 500 and they can put the rest of it in the annuity.
You know, and I think lastly, what I'll say about that, some of these sellers that are on the fence, right? Some of them, and I know because I've given presentations, they show up without their realtor, they show up without their tax person, they know best. And sometimes you have to get them to slow down a little bit. It's like, wait a minute, there's some things that you're saying aren't necessarily correct, but here are some options. You know, it could be some of these folks you may have spoken to in the past and now are thinking, you know, I should go back to these folks because there might be another option. And sometimes we go through this process and sometimes a tax expert will get involved and say, that is a great product, but seller, let me tell you why this other product is best for you at this particular time. That's fine. Again, we've done our job, right? We've educated, we've given you the information so you make an informed decision and you can go forward. And hopefully the word gets around that this is the type of information we're trying to get out there so they make that informed decision.
Well, you're acting as you said, an educator to your
Yeah.
clients or potential clients. And
Can I ask one more?
Yes.
absolutely.
Okay, so you're in a process like this. You've done this thing and the people are into, say, a 10-year annuity and they're in year 7 and somebody has a massive heart attack and has to go in a nursing home that's going to cost $10,000 a month and they're only getting $5,000 a month. You can't change that unless they die, right? You're nailed.
Cannot change that. You cannot change that. Yeah.
Okay,
So
just wanted to confirm that.
that's an excellent question. And so that's the downside. The upside, you've got guaranteed $5,000 a month to supplement the $10,000 if you can find the other 5 somewhere else, right? So
Okay.
it's still guaranteed income. It doesn't solve everyone's problem all the time, but I will say in promoting this product, I am also increasing the financial products, especially aimed at seniors, where, hey, maybe long-term care, these other financial products, maybe we buy a life insurance policy, we pay the premiums on the life insurance policy. So if something bad happens to you in the future, it'll trigger that life insurance policy. There's other products that are out there, and I'm talking to other folks as well, again, to see how can we improve your quality of life. So yes, you want to sell. And if we do this annuity, there might be other products out there that, you know, we might be able to get to put together to help you. Or said another way, you have a hesitant seller that has concerns, and Nancy, some of those are, maybe that's a concern. Maybe we can find some financial products that we can use the annuity to fund that addresses some of those concerns.
Is there a minimum?
Great question. The MetLife minimum is $500,000. They will make an exception on a case-by-case basis. My Puritan Life will take $100,000 as their minimum.
If they have
As
a lower
will
interest.
my U.S. Treasury bonds as well. So for some of those folks that say, yeah, MetLife's great, but I still don't trust them. Yeah, I think they may go under, well, we can do U.S. Treasuries. There's nothing safer than that. But as you've heard, I mean, people will say there's nothing that's 100% guaranteed, but a U.S. Treasury bond is probably as close as you can get to it. And again, if you were to Google how safe are fixed annuities, just Google it. It'll tell you it's one of the most financially safe products that are out there.
Yeah. Nancy, do you have any other questions?
No, these are great.
No,
questions.
I'm
These
glad
are
you've
great
asked. I mean,
questions.
all of
Oh,
those
thank
are,
you.
it's all important to open up that door.
Right. Well, your head starts spinning and when people ask you questions, you want to have the right answers.
Well,
Yeah.
this is where you can get Angel involved.
And this is what I'm starting to see.
You don't
as
want to
well,
get
if you
too
don't
deep
mind,
into it. Yeah.
is some of the older folks that maybe they have a home and moved into an assisted living and the house is living there and the kids are in the background and they're kind of just waiting to see what happens. You know, I not to say I've been surprised, but it's interesting to see that almost any time you have 2 or more heirs, you're having issues after the fact. they don't agree on how to split certain assets. And so sometimes this product can, hey, look, if either we're going to sell it, set the annuity, or the payments are going to the trust. The trust has already been told how to divvy the funds. So I think it gives people another option if we can try to find a workaround that pleases them. And the last thing I'll say is, if you ever have anyone that wants to meet in person, I'm in Los Angeles. I typically travel the country to attend my settlement negotiations and whatnot. So if you have someone, and I know a lot of the elderly kind of just like sitting down with someone, if we're to that point, I can facilitate that as well.
All right, Angel, thank
Righty.
you so much. And I appreciate everybody showing up, and hopefully this has been beneficial for each of you.
Thank you,
So-
everyone, for your time. I
Awesome,
appreciate
thank
it.
you.
Thank you so much. Thanks, John.
Have a great rest of the day.
Yeah, thank you,
you,
folks.
John.
Bye now.